Thank you for waiting. Let's move on to the next panel, Beyond the Cycle, Strategies for Building and Leading a Fund for the Long Term. It's the panel discussion 1. The moderator is the General Partner of Will LLC and Chief Investment Officer, Mr. Rob Theis. The panelists, Meritech Capital Co-Founder and Managing Director, Mr. Paul Madera. From Emerson Collective, Managing Director, Mr. Brad Powell.
Thank you very much. Good morning, everyone. My name is Rob Theis, and it is truly a pleasure and an honor to be here, as always. Today, our topic is about venture capital over the years and its plans going forward. And we have two of my colleagues that I've worked with for a while, Paul Madera and Brad Powell, to help answer some of the questions and provide us insights and wisdom of what they've learned over the years and what it takes to invest in venture going forward. So let me just introduce Paul and Brad, and they'll give a quick overview of their respective companies, how they started it, and just a little bit of factoids, and then we'll go into the discussion about the interesting topics of venture capital today. All right, Paul?
Thank you, Rob. I have to say, before I get into my presentation, I first came to Japan 40 years ago, and that's because I was a young lieutenant in the U.S. Air Force flying F-4 aircraft in Korea. And I got to take the F-4 for a weekend to go to Tokyo to see a football game. And the reason I'm telling you this story is because when I flew in that evening, I landed at Yokota Air Base, which is to the west of Tokyo, as you know, and I got to fly several patterns around the air base before we landed. And the sun was setting, but it was just at the point where Mount Fujiyama was lit up and the lights of Tokyo were coming on below us. And it was, I flew for 10 years in the Air Force. That was the most memorable flight that I had the entire time. And so it's wonderful to be back here in Tokyo. Thank you for having me. So I'm currently at Meritech Capital Partners, which we started just about 25 years ago. And what exactly is Meritech? Well, we're a venture capital firm. We're one of the larger ones. And we think of venture as fitting into sort of 4 different phases of investment. And we at Meritech fit right into the later stage. So it's not the earliest, it's not the institutional rounds, it's not the pre-IPO, which would be 2 years or so before IPO. We're in the stage where companies are at about 10 million to 50 million in terms of run rate, and they're raising a modest sized round of capital. Might be 50, maybe up to $100 million. That's been our focus from the start. That is our focus to this day. So over the years, starting in '99, we have raised a total of 8 funds. And interestingly enough, the 8th fund up here, we still have not started to use, even though we raised it a year ago. And that's because investing in our sector is a little bit slow right now, which we'll get into a little later. But over the years, or I should say since 2003, which is noteworthy to us because it is the time when we separated from our initial sponsoring funds, we invested into 4 early stage venture capital firms' portfolios for our first few years. And in 2003, we went independent and sourced our transactions from any company in any tech sector. And over that period, since 2003, we've made just about 160 investments. 2/3 of those have gone through liquidity. The median time for those to go through liquidity has been just over 3 years from our time of investment. We've been able to return just over 6 times the money in aggregate on those investments, 43% IRR, and $11 billion back to our, or total back to all investing partners several times what we actually invested. So our team is not a big one. We have a total of 20. We have 10 on the investing side, 6 general partners, 2 partners, and then 2 associates to help us out. And then we have a group that helps us both do some data analysis and some stats that are available publicly on our website. Our strategy is similar to many other venture capital investors. We do look for the best companies. We look to be in the sectors that are the most dynamic. We look for companies that where we can make a difference and we have something of value to add. And over the years, we have invested across all of technology. I hope some of these logos look familiar to you. I would tell you that there's probably 3 sectors that have been the most productive for us. One is that top layer, that systems of action, platforms we call them. In addition, community-based platforms has been productive for us. And lastly, data management and analytics have been a great place for us to invest. So that's Meritech.
Okay. Thank you, Paul. Brad?
This is my first time in Tokyo, so I can't tell you a personal story about being here before. But I'm Brad Powell. I'm the Managing Director of Investments at Emerson Collective. I'd like to thank the Ministry of Economy, Trade, and Industry, Rob, and the World Innovation Lab for giving me the opportunity to talk to you today. I'll present a somewhat different approach to the long-term successful private equity investing than you may hear from others. One of our success in delivering positive impact for people and the planet are a key priority. We believe that this approach delivers true alpha and a differentiated valuation multiple. Building a mission-driven, values-aligned venture firm that delivers top quartile returns is not easy, but it will yield world-class results. Emerson Collective was created on the belief that our world's most pressing challenges are interconnected and require ambitious, often cross-disciplinary solutions. We founded the firm 20 years ago, and we set it up for maximum flexibility. We provide philanthropic support to nonprofits. We seek to drive policy change at the national level. And most importantly for this audience, we invest in private capital and commercial enterprises. In our venture investing, we look for consequential companies delivering generational impact alongside venture scale returns. We invest at every stage of private equity, from pre-seed to pre-IPO. And we support our portfolio companies with a variety of offerings across their growth life cycle. We provide this capital in all types of investments with a special focus on areas of high impact, such as climate, education, health, and media. Across those sectors, we look for entrepreneurs leveraging technology in order to bring innovative solutions to big problems. Like you will hear from others, we seek founders who are aligned with our values and the positive impacts we want to see in the companies we invest in. We are very clear. Financial success is extremely important, but it is not the only criteria that drives our initial investment decision. What I've said is accurate, and that was what we strive to achieve. But in reality, we have come a very long way and learned a great deal. We have made mistakes, but overall, we have experienced tremendous success. I thought I would provide an example of what I'm talking about. One investment that we made that highlights both the investment intent and the principles that drove it, as well as some of the things that we learned. About 6 years ago, we had the opportunity to make a relatively small investment and gain a majority ownership in an education company called Amplify. Because of mistakes that had been made prior to our involvement, there was a lot of risk and significant additional investment would be required post the acquisition. The company had lost its focus and was trying to do too many things and had become large and unwieldy. We were repeatedly told by education experts that we would never see a return on our capital and would probably lose our entire investment. But we knew that the area the company was focused on, core curriculum, was a massive market that could have a large impact on the lives of children. And we believed senior management and their deep commitment to creating the best learning tools was a winning strategy. We knew that the existing market was dominated by providers whose products were not well loved by their users, nor were they very high quality. Upon investing, we asked the management team to make difficult choices. Non-core assets were spun out and sold. Some of the products were discontinued. The team was massively reduced to cut costs, but at the same time, we continued to provide capital to produce the highest quality education curriculum, built a clear vision and roadmap, and we invested in a new sales team to win in a highly competitive market. Over the course of 6 years, we continued to invest in the company, and we have seen the results. During that time, the company grew its revenue 14 times, from about $50 million to over $700 million. The products have repeatedly received the highest ranking and awards, and Amplify went from a damaged and nascent brand to being widely regarded as the most consequential company in K-12 education in the United States. Today, that company is worth several billion dollars. What are our principles behind our investments? Well, in the case I just cited for you, we knew that the education market was massive. We also truly believed that we had the right vision and the execution, and we could achieve high impact with outstanding outcomes alongside of significant financial returns. Most importantly, we were completely aligned with management in terms of values and the results we were trying to achieve. While we had control over the company, we still approached it as a partnership with the management team. We believe that our shared vision also pushed them to improve and become excellent at operations and execution. Today, we have shifted our focus into one of the most impactful opportunities of our lifetime. In fact, if we don't succeed in catalyzing massive amounts of private capital to save our planet, it may not survive. The imperative to be a catalytic player in the global energy transition is the most impactful opportunity of all of our lives. The addressable market dwarfs anything else that exists today. We intend to bring all of our resources, our network, our partners, to address this critical threat. These include supporting the sector and our companies with marketing, communications, legal, policy, fundraising, and philanthropic support. We call this the power of the collective. If you believe, like I do, this is the existential challenge we are facing that must be met with our collective ideas and innovative thinking, then do not think twice about also focusing your efforts in this area. Anyone in the audience today that wants to join me in this, I'm glad to speak with you this afternoon. Thank you so much for listening to my presentation.
Thank you, Paul. Thank you, Brad. That's wonderful. Can we bring up the next slide? Just want to use that as a kickoff. Okay. First of all, I do want to thank all the people, all the speakers that have come here today to talk to you. And we're here to talk in this panel about the evolution of venture capital and what it takes to develop a long, sustainable, durable venture business. The venture model has been around actually for a very, very long time and started in the 60s, and we are happy to have all the firms here that represent the various vintages of all the different decades to talk to you about what they have discovered, what they have invested in, what are some of the strategic insights. and also the great companies that have been built over the last years. But I just want to leave one interesting note before we get started. Venture capital actually started a long time ago. And depending on who you talk to, it was back in the 1400s. And as part of my research, whether that's correct or not, the earliest form of venture between entrepreneur and investor, I don't know if any of you would identify it, would be Christopher Columbus. So Christopher Columbus was an adventurer. He was an entrepreneur. He wanted to not only seek an opportunity in the new world, but he wanted to build riches and create, and also have a different way of life from migration from Europe and so on and so forth. I don't know if you know, but it took him 10 years to raise capital to do this journey. He went to Portugal. He went to England. He went to France, talked to the monarchies, to the wealthy people, and eventually one did listen, and that was Queen Isabella. And the deal he cut with her was very simple. I think there's a new opportunity in this new world. I need you to fund me for this adventure. And by the way, I will share the profits with you. And that profit structure that was created was a 90-10. And it was essentially the beginnings, if you could believe it, I'm not sure if it's correct, the carry structure. It was a 10% carry of the gains that would be discovered in the new world. So if you want to talk about venture capital investments, many generations, and from there are many different entities and different individuals that has evolved. But we're not going to do that. We're going to bring it to the current, present, and let's talk about that. So let me just ask the question. Both of you are co-founders of starting your firm. Let me just start with you, Paul. How did you start it? How did you build it? And what was it like in the beginning, in the early days, and then eventually, has it changed much? Is it any different?
That's a great question. So we actually cheated a little bit. I was an investment banker, and I had the help of 4 well-known early-stage firms: Excel, Oak Investment Partners, Worldview, and Worldview is a Japanese connection here, as well as Redpoint. And they did not have the capital. They had small funds. Then 100 million was a small fund. And they wanted to be sure they could fund their companies, of which there were a growing number, that needed to raise another round of capital before they were big enough to go public. So they thought that by setting up their own sort of sister-brother fund, that they could help fund those. So they called me up. I was a banker, asked me, I'd done some work for them. They asked me if I would help them start their fund. So we started Meritech on that, and we raised the first $1 billion fund right before the peak of that chart there that we see in front of us. And so at the time, at least initially, there was a number of great investments to be made, and we deployed capital very quickly. But within 2 years, the tech bubble had started down. We had a very large fund. We didn't have many places to put it. We didn't have any competition, though. There was no one else who was trying to invest in companies of that sort at the time. And so we found ourselves in a very longer, dry period. We did 2 deals in all of 2002, for example.
Wow.
And didn't raise another fund for several years. Anyway, flash forward to today, very different. Today, the late stage market we invest in, there are many investors, there's a great deal of capital, and there are also a lot of companies as well, although there is a pricing issue today that is a temporary imbalance.
Okay, thank you. Brad?
Well, as I promised, my answers are going to be different.
That is wonderful.
So the way it worked for us, originally we were founded as a social change organization, and we did all our work philanthropically. But I was not really that well versed in just purely giving money away. And I said, for my whole career, what I've always done is built businesses. And so I sort of said, why can't we do both? Why can't we work in the sector and help support the nonprofit organizations and at the same time invest in for-profit companies alongside of those? Because what we found, or what I found that was very frustrating in the nonprofit sector, that is something none of us love doing, which is raising money. That's all you do. But if you have a for-profit company, the best place to go and raise money is from your customers. So the idea early on was to say, hey, can we invest in the best-in-class companies that also will deliver products and services that are highly desirable? And if we align that from a mission perspective and a value perspective, we've now created an entity that actually can be self-funding and can actually provide enormous amounts of capital into the sectors that we're looking to drive the positive change we hope to see in the world. So that was the theory behind it. How we got started is no different than a lot of the work that you do at Will, right? It was just me, no one else, and I didn't know a whole lot about education at that point. So I went out and I sought out the best venture capital funds that were focused on education, and I said, hey, can I invest in your fund? And they were like, we would love that. And then we built relationships with them, and we traded information, and we traded services. Things that we would do to support companies are typically quite different than what a traditional venture capital firm might do. And therefore, we had these very strong partnerships that allowed us to both learn, to share information, and collaborate together in a very non-competitive but complementary way. So that's how we got started.
Let me just expand on that a little bit more in terms of the going forward basis. I know you guys are looking at many exciting things. People, climate. Venture capitals have a tendency to be lemmings in that they all like to invest into the same things and pile into it. But you always have a very unique approach and a very differentiated approach. And I know you're investing in lots of exciting things. Can you just talk a little bit about, what are some of the going forward things that that excite you today? I know you touched on that a little bit, but a little bit more, right?
Yeah, the biggest area, I was very fortunate, again, a lot of what I do is what we call listening and learning tours. And so fast forward half a dozen years or so from 15 years or ago, I wanted to expand outside our education footprint. And I really was very interested and concerned about what was happening with our environment and our planet. So I really wanted to learn more. And we did what was called this listening and learning tour. And one of the people that I got to meet, who actually, I think he passed away just today, is Chuck Feeney.
Oh yeah, yes.
Who had formed and was sort of, I wouldn't call him a mentor, but certainly somebody that I emulated a lot, where he had formed Atlantic Philanthropies and then General Atlantic, which went on to become one of the most, one of the most famous and profitable private equity groups in the world. And when I met with Chuck and understood what he was trying to do, which was to have the types of positive change that I was looking for, and through these discussions, understanding that education, while it's so important in our world today, healthcare, another area that we invested in, so important, those things didn't totally matter if we really didn't figure out a way to work ourselves out of the problem we've done in terms of our environment and what we're doing to our collective home. And so it was right around that time, 6, 7 years ago, that I decided to pivot and really start to build an environmental and energy practice that could use the same principles that we had already implemented in our education and healthcare work of basically using this cross sort of pollination approach of understanding what was going on in the nonprofit sector, understanding how important policy is, public policy at both the national and the local level, and bringing those things into the venture capital process. But private capital is really what drives and can change the world at scale. And so that's kind of the direction that we've been going in over the last half a decade or so. And that's what I plan to do for more or less the rest of my life.
Wonderful, wonderful. Paul, what are your thoughts here about what you're thinking is an interesting areas and where you've invested very successfully in the data, infrastructure, application spaces? What are some of the things that you guys are looking for and considering at this stage?
Well, I would first say I'm awfully impressed by what Brad's doing, but unfortunately, we're a little more lowbrow, I think. What we have seen in the past, ironically, back when we got started, the venture capital sectors to invest in were quite small. I mean, it was semiconductors, it was Wi-Fi, it was communications equipment boxes. And that's why funds were small too, because the investment area was pretty narrow. The one thing that no one invested in 25 years ago was software. And the reason is simple. Any sort of interesting software company would immediately get aggressively attacked by this big behemoth called Microsoft and run them out of business, and they never turned out to be good investments, so no one would write a check into a software company. Today, of course, it's entirely different. The internet came along, the internet has enabled the transmission of software, the utilization of software, and of course all the functionality that comes along with that. And so what we have focused on today is roughly 2/3 into enterprise-oriented software, usually a subscription service model. The other third tend to be a little smattering of some healthcare devices, some security-oriented offerings, and even a little bit of hardware in there.
Are there any gotcha areas that you would try to avoid these days, or
nothing like software so much anymore, but some of the commoditized areas wouldn't make a lot of sense. The Wi-Fi, semiconductors, and the like.
Okay, wonderful. I'd like to change topics slightly, and you touched on the venture capital, and all businesses go up and down, right? So would like to kind of get your thoughts on, what are some of the learnings in the market cycles? What do you do differently in up and down markets? I know, as a venture capitalist myself, we love to complain. We love to complain when the market is high because everything's too expensive. And we've experienced that in the last 24 months or so. We also love to complain when the market is in the down toilet because nothing is going on, and then we have down rounds and so on and so forth. And as venture capitalists and as mentors and coaches to entrepreneurs, these are very, very challenging situations because there are certain things that you can control in life, and there are certain things you can't. And you can't control the macroeconomic situation. You can't control that the Federal Reserve is raising interest rates in the United States to control inflation. You can't control that we had challenges this past weekend and a war that is potentially emerging, including high oil prices and so on and so forth. But how do you help your entrepreneurs, one? Two, how do you structure and align the venture business in what you raise so that your firm and the entrepreneurs can navigate these up and down cycles? Sorry for the long question, but I think a lot of people here would be very interested because we are in one of those transitional states today.
Me?
Yeah. Or either
right.
way, yeah.
I'm glad to go, but you go this time.
Oh, thank you. That's having lived through 4 significant economic cycles, it has really affected how Meritech approaches it. And maybe there's two different answers to this. One is, what do we do as investors? And the other one is, what do we do as advisors to companies?
Okay.
So as investors, it has been we learned early on, of course, having started out in the middle of that tech bubble, which affected us greatly, and many of our companies did not do well, went out of business and the like, and we had to deal with all of that. We learned to be more conservative. We learned to be much more careful in terms of how we invested. We learned not to write too big of checks and so forth. That has persisted to today. And so where many of our peers in the venture industry have used the last several years, which have been very productive and lucrative in the venture capital world, to raise much more money, to expand their strategy, to get into many new areas of investing and the like, and even raise different sector funds. We've chosen to be more conservative and stay focused on the same category of investing we've done, not take all the money that was available, to be more conservative in terms of size. So that's how we have approached the cycles that are sure to come. When it comes to advising companies, though, it's different. Our job is...
That's very hard.
That's very hard, exactly. I mean, companies are fragile, as we know, startups especially so. And our job is to be encouraging, to be supportive, to be advisors, to try and help the companies make the best decision, but never tell them what to do. We can't. We're not majority owners. We own a slice that's less than 10% usually, and other investors have similar slices. None of us can control the company, and so we're more advisors, and that's how it works. And many founders are naive to a certain degree, and so they get caught up in what they hear from their friends and so forth, and they may not want to hear the advice that says, we raised a lot of money, but we're burning too much. We need to change that. And so we have to find different ways to encourage that and make sure the data gets to them. So we at Meritech have done one thing. It's available to anybody who goes to the Meritech website. We have a lot of data on how the public sector companies are trading, and what multiples and how have they changed over time and the like. And it's particularly focused on subscription software companies. And we use that data very intentionally all the time to go back to companies and make sure they know what they should be striving for, how they should look, how do they look now, and help advise them in that way. So the decision becomes theirs.
Wonderful. Brad?
I don't know if my answer is going to be significantly different than Paul's. Maybe at the macro level, so I'll reverse your question like he did, or my answers. We have an enormous opportunity in terms of our capital is quite flexible. And so in the macro environment, we tend to take a more contrarian type approach, kind of like the Warren Buffett of be fearful when others are greedy and be greedy when others are fearful, right? So at a time when there's distress in the market and there's disruption, we view it, that's when we can step in and be catalytic, because we believe all of this is cyclical. And so, and part of, I view my job is to be catalytic in the sectors that we work in, to go and try to crowd capital in to really try to tackle some of these most challenging social issues that we have. You don't need to do that when the market is exuberant. You don't need to do that when others. So that's a time to step back and take account. And like any other investor, we need to get liquidity from time to time. So those tend to be more of the opportune times to do that. But when there's distress, when others are pulling back, we step forward and try to lead. So that's on the macro side, and I think that might be somewhat different than your tradition. On the investor entrepreneur side, we're exactly the same. In fact, we take that same approach. When there's times of optimism and exuberance and everybody wants to grow at all costs, we tend to be the voice of reason and say, you know what, we have an opportunity to build a sustainable, infinitely lasting organization for the long term. Let's make sure we're taking advantage of that we structure ourselves appropriately, and we are prepared for when inevitably we're going to see a turn in the market. And like I said, when the market is distressed and companies are, and the founders in particular are really struggling, that's when we want to step in and be optimistic and really lift them up and give them the support that they need. So very similar, I think, to Paul's firm in terms of how we deal with the founders and the management of the companies we invest in. But we do, on the macro side, we tend to be very, very counter-cyclical in terms of our behavior. And that's because our top priority is really to encourage others to come into the sectors we're in and say, come on in, the water's nice, we can all benefit here from a rising tide.
Fascinating. Well, it seems like though your firms are different, you have similar tactics and strategies and messages on how to help the entrepreneurs, including how you run the governance of the firm. That's good to know. Mm-hmm. Let me switch topics again. Let's talk about technology and innovation, and where does that happen? There's a belief for the longer period of time that all innovation occurs in the United States. I don't think so. Innovation has occurred in many places throughout the world. Silicon Valley has just happened to be a hotbed because of a combination of entrepreneurialism, no need to fear change, can take a risk, and so on and so forth. So it was good for that, but capital also becomes a problem. And now capital seems like it's available in many different places. And we see innovation that's occurring not only in the US, in Europe, in China, in Japan, right? And however, it seems like the mindset is still on the US where innovation occurs. Tell me, or what do you think are the issues there? Because a lot of people have great ideas. A lot of technology gets invented and many different places, but what do you see as the shortcomings or the issues or the challenges where technology can innovate or does innovate in other places, but they just don't flourish and becoming into a full business or a company? Brad?
Well, first of all, I fully agree with your thesis there, that opportunity is what is limited. I don't think intellect or the ability to be creative and innovative is limited to the United States or any company or country in particular. I think it's ubiquitous. What we don't always have in other places, even within the United States or other parts of the world, is equal access to opportunity and also equal access to the best education. And that's why education has always been a pillar of what we work on, is because that's how we're going, an educated, people are what's going to drive that innovation, drive that creativity. Now, I want to say, all of our portfolio and the areas that we invest in, while it is education or the environment or healthcare, they're all technology-enabled or technology-levered solutions. So we focus on those innovative ideas, those creative ideas, particularly as they're using technology to further their product or service that they're offering so that it scales, because that's probably the biggest differentiator we see, is that technology can just open up vast markets and allow for the best opportunity to scale the fastest. So we deeply believe that, but we also deeply believe that that can occur anywhere. And we've looked all over the world. We've invested in other parts of the world, even in some areas where you wouldn't think, like East Africa, where we just funded an EV startup and an EV charging system, because those places offer an opportunity to utilize technology and leapfrog over legacy systems that they don't have to contend with. And so sometimes you can find the best opportunities in the most unlikely places.
Fascinating. Paul?
A couple of thoughts, actually.
Yeah.
Today, we find, even though our main office, we have one office in San Francisco and one in Palo Alto, we're finding over half our investments are outside of Silicon Valley. And that's because the opportunities are popping up today in a way they never were. When I started in this business, there were kind of two places to look, Boston and Silicon Valley. That was really it.
Yep.
There was nowhere else. You know that.
Yes.
And today, of course, there are places popping up all over the US, but also internationally, because what are the elements that a startup environment need? They need access to capital, they need the education that Brad's providing, and they need management talent that has seen and done and can lend expertise to that. And I think of Berlin as being a wonderful example, perhaps, for all of us. I mean, Berlin, in Germany in fact, as a whole, was very focused years ago on the best and the brightest going to large companies and working for Porsche. That's #1 desired career field for engineers in Germany years ago. Today, and no one was interested in going to startups and so forth. Today, Berlin has a thriving startup community. We've invested there, and there are many more interesting companies coming out of that environment now. The problem with Silicon Valley, by the way, is that when we go look at a company, the things that we don't want to see are, I shouldn't say we don't want to see them, we like seeing this, but it means they're going to be very expensive. Yes. It is well-known entrepreneurs who are starting a company. They are backed by brand name early stage investors. They're in a hot sector. They have hired a group that is only available to the very best companies. And that means every source of capital in Silicon Valley and beyond is looking to put money in, and the price gets bid up. So that's less interesting as an investor.
Interesting. Can you, just a follow-up question, Brad, what are the detractors that technology and technology-enabled business in different locations or geos that you've seen? You talked about the ingredients to find great entrepreneurs, great business, technology. Then what are some of the detractors? And there are many different ones, right? That makes it problematic. Just do you have any quick thoughts?
Well, I'll reiterate some of the things I said in my remarks. Right. First of all, you always want to find the absolute best, smartest, most talented entrepreneur, somebody, but much, much more importantly, is to make sure that you are aligned on your values and your vision together. Okay. So those are the issues. I mean, the technology, I rarely find in our work as being the issue, you know? Okay. Because typically we're looking for, we've de-risked, the technology has been de-risked to a certain extent. So it's not always where you're going to have the detractor or the challenge. It really comes down to the people. You want the most ambitious, motivated, focused entrepreneurs in your portfolio who just are going to drive towards, you know, the outcomes that you want to see. Or what I'm saying is to make sure that those outcomes, that vision is completely aligned, that you and the founders and the management team all believe that you're all rowing in the same direction. That's where I have found to trip you up. Usually, you know, there are cases where the business model that they're pursuing doesn't work. Sometimes you pivot, sometimes it's too late, but it's rarely those things. It's usually there's a misalignment somewhere and you start to pull in different directions, and that starts to really cause some concerns.
Okay. Anything to add there, Paul? No? Okay.
That
All
was
right.
so good, you had nothing to add.
Okay. Let me touch on another topic. This topic always comes up when it's in a down market, and that is fund sizes. Yeah. LPs, people that provide money to the firms, it's like, is that really a problem, or is it not a problem? Or is it just a manifestation of VC guys just love to complain? You want to take that?
It's a problem.
Is it? Okay.
Well, I tend to think it is, but I'm the conservative guy now, remember.
Okay.
And I think, you know, the venture capital community lives in excess, as you sort of alluded to earlier. You know, when times are good, all kinds of sources of capital want to invest. Yep. VCs take that money on, they build large funds, it works out for a while, and then after, it's like investing in last year's hottest mutual fund. All the money pours into it, the fund doesn't do quite so good the following year for all those reasons. And so I do think fund sizes are a big issue. Maybe less so in the early stage world. Okay. We're in the late stage world. That has been a very popular place to pour money into in the last few years because the returns have been good. And today there is a tremendous amount that's sitting there. Fundraising is not as active right now, but there's a lot of funds that have already been raised and are are going to try to be put to work in the next few years. So I think the fundraising interest is lower right now, but we have some excess to work off, and then it'll pick up again.
Okay. And Brad, you have a perspective on this?
Well, again, as usual, I'll be slightly different here.
Wonderful.
We don't necessarily, we have a similar but different issue, and that is we aren't as constrained by fund size or cap. We have just one big fund.
Okay.
And so that is obviously a huge benefit, but it's also a real challenge, and I'll tell you why. You know, when things are going well, and as Paul said, there's plenty of capital, there's no issue. But when the market gets challenged and the capital starts to dry up in other places, it does start to expose the companies, A, that may not be perfectly aligned with you, or B, just haven't figured out the right business model, go-to-market strategy, product market, whatever it is, they haven't quite gotten there. And so the challenge that we have is that everybody around the table all of a sudden takes a step back and we're the only ones left. And they're like, oh, are you going to now single-handedly support this company that isn't doing well and most likely without your support is going to fail? That's where we really have, they're very challenging because of our approach of getting in and supporting, you know, the founder, the entrepreneur, the management team. But when it's not working, somebody has to make those hard choices. And somebody says, listen, there are an awful lot of places that we can deploy capital, and we are looking for a return, not just on our capital, but also on the impact and the outcomes that that capital will achieve. And those hard decisions of saying, you guys are just not cutting it, you're just not delivering what we expected you to do, that's where, so we almost have to restrict our capital in a much different way than, say, the market would restrict it.
Interesting.
But it's probably the hardest thing that I have to deal with over long periods of time, is when you have to finally say, listen, we can no longer, and we're typically the last one standing. If we say no, then a lot of times there are no other alternatives. And those are hard decisions.
Interesting. Different, but also similar in that perspective. Yeah. All right, I know we have a few minutes remaining. I actually would like to open it for questions to the audience, but before we get to that, I don't know if people will actually ask questions here, but let's do some, two questions that maybe I'll put you on the spot a little bit. The first one is, what's the most exciting investment that you've done?
Whoa.
Well, it's almost like who's the best child that you love?
I know, that is hard.
I know that's an unfair question.
And I have 4 children, but I've probably invested in over 300 companies, so that is a hard one. You know, I'll give you more of a generic answer.
Okay.
Because I think it's also going to be the similar answer to your follow-up question. But I'm just guessing here, right? So the most exciting investments I have is when you meet that founder at a super early stage. You know, we invest in the full cycle. So we'll invest in companies that are pre-IPO.
Okay.
And that's, to me, and as you know, we invest in fund-to-funds.
Yep.
No direct involvement, but I get the most satisfaction when you find this super early stage entrepreneur who has this brilliant idea, and you have to make this evaluation of them to say, A, do we have the same vision? Are we aligned? And then B, do I think this is the person that can actually execute and make this idea come to reality? And those are the most exciting when you start to really put those pieces together and they all fit. And the final thing, which is part of the B equation, is, and I think this is one of the challenges that the Japanese have, is the willing, are they of a quality of leadership that they're going to be able to attract the best and the brightest to come along and do this creative, innovative, new startup that could be revolutionary, that could really have true impact, that could become a very big and important company. You know, trying to tease that out, trying to find those, and I've found a bunch of those. I've found a lot that were duds, but you know, when you find that one and you're part of that ride, there's just nothing that replaces it. And it's very fulfilling because seeing the product of your work, seeing that you started with almost nothing, an idea, and it becomes a real company employing tons of people and impacting people's lives, that's super fulfilling.
Okay, that is a good answer. Well said. Paul, what is, you don't have to say one, maybe several. What are some
I'll give you a couple.
most proudest, and yeah.
So for me, it's been Salesforce and Facebook.
Okay.
And another one that you've never heard of called Dealer Socket.
Okay,
And I'll
that
tell you
is a
why.
new one.
So Salesforce, which we invested in 2002, right at the end of 2002 or beginning of 2003, it was really one of the first companies to go public after the tech bubble started coming, after it burst and come back to life.
And cloud was very, very early.
Very early. No one understood what cloud was. They had a hard time following that software with the red line through it symbol that they had. But we found that our portfolio, and by the way, at the time, CRM, which Salesforce provides, was actually dominated by a company called Siebel Systems.
Absolutely.
You know, Siebel.
Yes, Tom.
Siebel was fully function, hard to install. All the largest corporates would use it. But it was expensive, hard to install, and Salesforce had 80% of the functionality, and that's what our portfolio started buying. So when we found several of our portfolio companies starting to use this thing, I ran it down. It turned out Salesforce had never raised any venture capital because they couldn't. No one would write a check to Mark Benioff.
That's right. That's right.
And so it was funded by Benioff and all of his friends.
That's right.
And at the time, I got connected to one of the friends, the chairman, who was a guy named Halsey Minor.
Oh, yes.
The chairman owned 12% at the time, and he wanted to sell a couple percent. It took me 9 months to negotiate that deal with Halsey Minor. He always wanted a price that was too high, and as I kind of got up to it, he would raise it again. Anyway, 9 months later, we finally agreed. We invested at the then unheard of price of $500 million for the corporate entity value.
Wow.
And
Back
we were
then.
laughed at. We were laughed at for being so profligate in investing at that price. Anyway, it worked out okay. And then Facebook, we tried to invest in MySpace. We couldn't get in because it got bought out from underneath us as we were negotiating our deal. And so we went looking for the next best one. And the next best one was way down in terms of revenue and actual usage. But Facebook was that one. And we invested in that one also at $500 million back in 2005.
Okay.
Yes.
Well done. Thank you. All right, I know we're definitely running short on time. My last, I'll take it down at the end. What's the advice you can give to someone today that would want to start a venture capital business or an investing business? Either one of you guys.
You know, I would encourage you to do several things. One is figure out how you're going to be differentiated. The world probably, and you're talking about starting a fund, right?
Yes.
Yes.
Or even if, well, yes, let's keep it to that because there's multiple dimensions that we could talk to.
There are. As a fund, figure out what you're really going to have an expertise in. Where are you going to be able to understand the world or a sector better than everyone else? Where are you going to get the dynamics that are going on in there that make a difference as to whether or not you invest in company A, B, or C, or D, or whatever? Secondly, ensure that you have something of value to provide to companies. You can't just write a check and tell them you'll show up at board meetings and vote. You have to think about what does that company really need. Entrepreneurs are very proud people. They are driven, they work incredibly hard, and many times they don't want to ask for advice, but they'll very willingly accept it if you come to them with good advice or good ideas or help talk to them. And lastly, don't be arrogant. There's many venture capitalists in our world who are arrogant and difficult, and they think the success at their startups are due to them. And nothing could be further from the truth.
Yeah, don't get confused.
That's right.
I think Paul's answer was excellent, so I hope a lot of people were taking notes there. But I'll add a few of my own things on top of what he said, but I would definitely utilize some of those ideas if I were starting a fund today. But again, I'll reiterate a few of the topics that I've talked about. Number one, I think you want to focus your investment in areas that you're going to add value, but you typically will add value if it's something that you find personally fulfilling, that you bring a passion to it, just like you're trying to discover the passion and the ability to execute in those entrepreneurs you're going to invest in. So I think first and foremost, make sure that that's important. And then I go back to what I've said earlier, is that alignment is so important. Investing in early stage companies is really a partnership, and you have to be aligned, and you have to have the same values, the same ambition, and the same vision of what you're trying to accomplish. Now, obviously, you're not going to do it day to day, but you're there to be supportive, to provide advice,
Right.
to make connections, to open up your resources and your network to help in any way you can to make sure there's a successful outcome. And you're only going to do that if those two things are in place. If you really have a strong passion, you get up every day and say, I want to, this is something I want to work on, and you enjoy and have a connection with the people you're working with, because that actually drives that, your desire to see something really come to fruition.
That's wonderful. So just to parrot what Brad said, I will give you my one closing comment. Exactly from what he said. The reason I love this job, the reason I do this 7 days a week, 7 by 24, for me personally, is one, it's a very hard job to do. And don't get confused. It is probably one of the hardest jobs in the world. But the most fulfilling part of this job, what I tell my 3 children, it is the only job in the world that you can see the future.
Yeah. Cool.
And if you just think about that, every entrepreneur, every person that you talk to, they will tell you their aspirations, their dreams of what they want to build. And what I get in terms of the greatest satisfaction in the world is after talking to some of these and waiting 2, 3, 4, 7 to 10 years, seeing the manifestation that they have been able to build what that dream is, and that I was one that was able to talk to them in the early stage or at whatever stage, and realizing that that dream has been fulfilled, whether I invested or not, whether I gave advice or not. But it is truly the only job in the world that you can see the future. So I think we have a minute. I don't know, will they allow us to allow the audience to ask questions? But if so, let's take the 1 minute, maybe one question. Does anyone have a question to ask either Brad, Paul, or myself? Well, yes? No, I think the moderator.
You've got a couple in the back
there is. Yeah,
Way back there.
in the back. So you have to yell.
Or stand up, because
Stand up.
it's hard for us to see. They have
Yes.
these bright lights, so we really can't see any of it.
Yeah, one question. I'm sorry, can you just repeat yourself? What is the most important lesson?
From?
Why don't you start that?
Yes, that's
I
a
mean,
great
I think
question.
we kind of hit on it, is that you really have to love what you're doing. You can see it from all 3 of us up here. Rob said it great. These aren't hard jobs. I mean, this is a very hard job, and you have to make very tough decisions at times. So you really, that passion, that desire to keep going and to make sure that that's what drives you, I think that's my biggest takeaway, my best lesson learned.
The only thing I would add is that key for every successful fund and entrepreneur is that you will face tough times. There will be times, we almost didn't raise our 3rd fund. We almost went out of business, like many did at that time. Entrepreneurs face that same cliff at times, and you have to drive through that. You have to persist.
Yeah, wonderful.
Yeah.
I will give my one answer, and that one answer is your reputation. And you can decompose that to many different things, from trust, integrity, transparency. But we live in a world of almost 6 billion people, but your reputation is the only thing that you have. And it's very small in that 6 billion people world, in that what you do, what you help, coach, advice, is what's going to propagate, and it's going to stand in terms of trust and capabilities with the entrepreneurs that you're going to have a relationship with. So thank you, Paul. Thank you, Brad. And we're all around today, so please, talk to us during lunch, all the breaks, and so on and so forth. Thank you very much.